Welcome to the channel. I'm the Swedish dividend investor, and today I want to take a look at Canadian Utilities, ticker CU. We're going to take a look at the numbers and calculate an intrinsic value. Before we begin, I just want to say this is not financial advice. I'm just a guy on YouTube who wants to help people think differently about investing. Make sure to read the full disclaimer in the description down below. To summarize it, Canadian Utilities is a diversified utility company based in Canada, primarily focused on providing essential service in electricity, natural gas and water. The company operates in various sectors, including electricity generation, transmission and distribution, natural gas distribution and water treatment. It serves residential, commercial and industrial customers, and it's known for its commitment to sustainability, innovation, and reliability in delivering these critical services across Canada and internationally. Canadian Utilities is part of the ATCO group. So, we're going to dive right into the numbers. And today, I'm going to use both Seeking Alpha and Morningstar. And we're going to start by checking the dividend amount. So we can see here, they are paying $1.83. We're gonna enter it here. And here is the valuation page of my spreadsheet. It looks messy, but it gets the job done. We need to fill in the data from the income statement and balance sheet so we can get an overview of the numbers and the growth. I also want to see whether the shares outstanding are decreasing or increasing. I'm going to go through everything after I'm back from filling this out. You can always check the company's annual report to check if the data is correct. And I have done that. So we can see 3.796 in revenue. We go over to here and we can see total revenue. It's the same number. I also checked for net income and it checks out. So I will be back in a bit when I have filled out everything for the data. Okay, so I have punched in all the numbers and I also did the cash flow statement while I was at it. Looking at the charts here, we can see the free cash flow is kind of growing, but it's a little bit all over the place. Maybe 2024 will look better. The dividend amount did not grow, but the dividend per share grew from buybacks. Maybe that's something we have to keep in mind. The debt is going up. Maybe that is expected for a capital intensive business, and they are paying around 500 million Canadian dollars per year in interest that could weigh on the profits. Their debt is above their market cap. Might be something to keep in mind also. Now that we have the numbers, we're going to check the dividend history and the growth of the dividend. Here we can see the company has hiked their dividend for 35 consecutive years. But checking the annual report of the company, they stated they hiked the dividend for 52 years, making them a dividend king. I have entered it in my spreadsheet along with the growth for earnings. The earnings growth was up some years and down some, but we're going to use an average of 4% since it's the long term that matters. If we take a look at the metrics here, I have a sort of summary here. So dividend over 2.5%, yes. PE under 24, yes. Free cash flow growth, yes, and so on. Now what I did here is to divide the debt with the 5-year average cash flow to see how many years it would take to pay it off. About 16 years. Yikes. That's with all the cash flow going to repay the debt, without interest. Alright, let's do some valuation now. I like to use the 5-year average to smooth out one-off years and stay on the conservative side. This page here is for the valuation on the cash flows. And here we can see the 5-year average cash flow. The 5-year cash flow automatically gets pulled here. and inserted into the first column here. We're going to use a 4% growth rate for the normal case, and I'm going to enter 10% discount rate. As you can see, I use different scenarios because stuff can happen. The market can be very optimistic and very pessimistic. Same discount rate for every scenario. We're going with the average growth rates and terminal multiple. The terminal multiple is the price to free cash flow multiple the market is willing to pay 10 years from now. Do I know this exact figure? No. I can only make estimate. But as we can see, the market gives a current price to free cash flow ratio of 10.6. So for the normal case we can use 10 and a bit higher and lower for the other scenarios. Alright, we can see the scenarios down here. And since the company is somewhat stable, we are going to put 60-20-20 probability, and we get the present value here. Apply a margin of safety. We're going to use 5. And here is the present value with a margin of safety. Before we move on, do you own Canadian Utilities or any other utility company? Let me know down in the comments section below. Moving on with dividend valuation. The dividend amount per share gets pulled from the previous page, and we use the same discount rate. We're going to use a little bit higher than the 1 to 5 year compounded annual growth rate for our growth rate in this scenario. For the best case, we can use the 10-year growth rate and round it down to 5%. Now for the worst case, I want to show you what can go wrong. Imagine what a dividend cut would do. We can try different numbers to see what the real worst case could be. Let's use very low numbers, say a 10% cut and then growth of 2% per year. As we can see, it gives a present value of $22.55. We're going to use 2% but with a lower terminal multiple. Now for the terminal multiple, this represents the yield year 10. To the left, we can see an example how to use it. I went with 20 equals 5% yield for normal case, 25 or 4% yield for the best case, and 12 or 8.33% yield. Now for the scenarios. I would say the most probable scenario is 70 normal, 15 best, and 15 worst, giving us a present value of $30.46, and with a margin of safety, $28.94. Heading over to the earnings valuation. I would like to add I don't like to use earnings. They can be manipulated more easily than dividends or free cash flow. For this valuation, we use the billion amount of earnings, same discount rate, and the amount get pulled from our balance sheet here. We use the growth rate we used in the free cash flow model. The terminal multiple is the PE 10 years from now. Let's use an average PE. We can see 11.17. So let's just stick with 10 for the normal case, 15 for the best case, and 8 for the worst case. For the best case, let's use the same growth but a higher multiple. Let's put 60-20-20 like we did with the free cash flow and a margin of safety of 5%, giving us a present value of $7.35, and with a margin of safety $6.98. Remember, both this and the cash flow is in billions. So 7.35 billions and 6.98 billions. This should be compared to the market cap. So if we head back to the main page, we can see the valuations and what I call a ratio. If the numbers is highlighted with green, that valuation is undervalued. If it's red, it's overvalued. We can also see a mixed valuation at the bottom. where we take all the valuations and make an average. This is calculated per share, so the billion numbers gets calculated to per share. And those are the numbers. We can see the ratios point to a fair valuation or slightly undervalued. Only the dividend points to overvaluation. For the mixed valuation, we can see a slight undervaluation, making it fairly priced with a 5% margin of safety for a 10% return. I don't know if this is really right for me. I think this company is a little too risky for a 10% return. The debt is high. It isn't really that stable, since the cash flows and earnings fluctuate a lot. The $500 million per year in interest payments is also off-putting. Then there is the financial engineering of the dividend growth. As we can see, the dividend amount in absolute numbers is going down or staying flat, but the dividend per share goes up from buybacks, probably with borrowed money. I could maybe take the risk, but at a lower price. Maybe if they get down to under $25, to give a little more of a margin of safety. We also saw what could happen if they cut the dividend, and that was just 10%. Try to always think like this. If it's not a clear yes, it's a no. I want to add that this is not financial advice. These numbers are based on my estimation, and there are a lot more than valuation to be considered. But that's it for this one. If you have a company you want me to do a valuation on, drop a comment. If you enjoyed the video, hit that like button and consider subscribing. It would mean the world to me. With that said, I'm the Swedish dividend investor, and I will see you in the next one. Ha det gött!